Hello, and welcome to the EDM webinar titled ESG Data Management Race into Mainstream Investing. I welcome Mike Meriton, co-founder of EDM Council. He will be kicking off the presentation. Over to you, Mike.
Thank you, Angie, and welcome to our EDM webinar audience. It's a fine day. This is an exciting topic that is touching everyone, no matter what you do. So welcome to today's discussion. So why are we all here? ESG considerations are increasingly a part of our collective consciousness, investors included. And bad ESG data is a common problem in the investment world and can prevent investors from achieving financial and sustainability goals. On the other hand, if used appropriately, good ESG data is the foundation of both values-based and value-based investment strategies that are no different than other metrics when evaluating investment decisions. Under the current model, ESG data available to investors is either low quality or requires significant investment in time and money to properly prepare so that it's usable. There are changes coming to ESG data collection and processing, and the market and the world stand to benefit if we can get ESG data management in a good shape. So with this, I'd like to go ahead and introduce our two speakers for today. First, welcome, Ben. Good to have you on today's webinar. A little bit of background on Ben. So Ben is the CEO and co-founder at OWL ESG, and transforming how ESG is gathered, analyzed, researched, and applied by providing an AI-powered software to revolutionize how professionals who need primary ESG data and analytics conduct their business. He has a BA from UCLA and has had 18 years of experience in the financial industry across a variety of organizations in asset management, advisory, capital markets, hedge funds, with significant expertise in exchange-traded funds or ETFs, indexing, and ESG investing. And Ben, you've been out on the circuit speaking about this topic a lot, so we're really grateful here to have you on today's EDM webinar. And again, welcome. Good to have you.
Thank you.
Awesome.
Thank you.
Our other speaker I'd like to introduce is Joseph Mezrich. So Joseph, good to have you. Welcome to today's discussion.
Thanks.
Good. A little background on Joseph. He is the founder of Metafoura, LLC. In July 2023, he's focused on quantitative investment research after 3 decades as a sell-side quantitative investment strategist at Nomura, UBS, Morgan Stanley, and Salomon Brothers. So Joe received his PhD in mathematical psychology and MA in statistics from the University of Michigan, and has received his EE and SM degrees in electrical engineering from MIT. And his work has been well covered by Bloomberg, FT, Financial Times, Wall Street Journal, and others. So Joseph, really great to have you on this discussion as well, and welcome.
Thanks.
Awesome. So Ben, I thought what would be great, we're going to get our audience busy with some polls, but do you mind setting the stage on ESG on the rise?
Yeah, no, happy to do so. I think probably most people here are well aware of ESG and its rising popularity. We do have some great statistics on this slide about the growing size of the ESG data market, which it's predicted to grow to multiple. It's at a pretty high amount, and it's predicted to grow significantly higher to multiple billions by 2025. And then we also have some information on the ESG software market that helps investors allocate and their portfolio, slice and dice in different ways to invest better through the integration of ESG considerations. But I think the big question is, why is this happening, right? What's really, really important to note is that this is really a ground up consumer demand, right? I'm not talking about consumer demand necessarily for investors, but consumer demand for corporations to become more how do I say it, more friendly to the environment, more beneficial to society, and to govern themselves better. And investors, including starting with asset owners, have responded, and those asset owners caused, of course, asset managers to start investing their dollars in that way, and that of course gets regulators involved, right? And now the regulators are getting involved, right, to monitor what's happening, and now the corporates. I mean, if the investors didn't get their ears, the regulators are, right? And so now the whole ecosystem is really invested in reporting on ESG, in integrating ESG into investment strategies, and it's through the whole ecosystem. And that's really, it's a really important point to note. The genie's out of the bottle, and it's not going away, and it's going to continue to grow.
Hey, Ben, I could amplify. The council has been approached by many executives in data management. It has resulted in the formation of a global working group that has now been operating for 2 years. It has 100+ companies. So ESG, and of course ESG data management, which is sort of that supply chain of data, from entities that report their holdings all the way to data aggregators and investment houses. That's a very intense and active that sets this dialogue, no doubt. And one other statistic, and you may have heard this as well, was a Bloomberg statistic that well over, I think, 20 to 30% of investments moving into this year and beyond will have some form of ESG tag. It's really not a subtle thing. This is a big movement that's going on in industry. Lots of money, and companies that are good at this are going to get dividends with their stakeholders. So this is a great topic. And I think we have a poll coming up, and Ben and Joseph, welcome your comments on it. So this is for our audience. If you could just take a moment, I think we're going to pop up the polling question. So here's what it is. It's a single choice question. In what way have you encountered the ESG recently, or encountered ESG recently? And your choices are through products, maybe investing products, investments, and also strategic decisions. Those are the choices. We'll give it a moment. And we have another category if these don't suit your needs. This will be kept anonymous. It's just a way to inform our discussion today and get everyone on their keyboards and involved. What I'll also let everyone know is while you're typing in your answer, please type your questions in throughout this discussion. If you have a question, just go right to that Q&A tab. What we're going to promise is we're going to hit as many of those questions as possible before the conclusion of the webinar. We have an open Q&A time, and anyone that writes a question, we will definitely give you a written response post the webinar. So every question will be answered. Okay, so here are the results. We got a reasonable percentage. The number one voted in polling answer, Ben, for you to start with, is at 45% strategic decisions. And then we have a tie, each at 17% through products or through investments. Ben, is that a surprise to you, these polling results, or not?
Considering the people who are the market of EDM, it's not surprising. These are people who are decision makers at very high levels at either corporates or institutional investors. And in a lot of cases at the corporates, they're struggling with issues on how to what ESG issues or topics should they focus on and communicate to the rest of the world. And so it's a very strategic choice for a lot of from my understanding of the audience. On the institutional investing side, you have a lot of chief data officers and what have you, and they're really just trying to figure out how to get quality data and disseminate it to the rest of the firm in ways that are thoughtful and effective, so those firms can use that data for whatever reason they're using it, whether it's regulatory reporting or whether it's in the investment process. So this doesn't surprise me at all.
Good. And Joseph, anything to add to these real-time polling results from our audience?
It occurs to me that there's probably a lag between the corporate strategic decision and what the investor decides to do with the decision of the corporation. So the fact that it's more prominent among the strategic decisions before or larger than the investments kind of makes sense, because as ESG grows in prominence, it first has to be a topic of consideration by the corporation, and then the investor has to react to that or to implement his dollars based on the decisions. So it's not really, I mean, it's a little, not too surprising, I don't think. So not much to add to that, but
Awesome. Joseph, thank you. So Ben, I think this sets the stage for data. Is it good? In the ESG scheme, I think you entitled this slide, the data debacle. So over to you to sort of explain to our audience, why is ESG data such a challenging activity for companies throughout that entire data supply chain?
Well, I think you have to take a step back and look at how ESG data has been used traditionally especially in the investment process, and what type of data they had access to. So first of all, and this is a repeating theme, ESG data typically is available through unstructured documentation. Until recently, from the perspective of corporate disclosure, there wasn't a lot of regulations on what corporates had to disclose, right? And so as a result, different corporates would be reporting on different things in different ways. Sometimes they're reporting on different things or the same thing from year to year in a different way. And every single corporate was doing it differently in different unstructured documents. So the problem you had was, how do you take this big, say, mess, right, and then synthesize it into something that's digestible and actionable in the investment process? And the solution to that was ratings, right? But the problem is, since all the companies are reporting on different things, and there is some subjectivity on what ESG issues are relative to which companies or which industries, what have you, each of the different ratings providers would have a different take on it, a different synthesis, and their subjective interpretation of how to interpret this morass of data and make it digestible. And as a result, if you look at historically, when our company started out, there was only about a 33% correlation between the different providers, like MSCI versus Thompson Asset 4, which is part of Refinitiv, or Sustainalytics, what have you. There's only 33% correlation between the ratings of any two vendors. That's actually risen to about 50%, but you still have about only a 33% correlation at sub-theme levels like E, S, and G and below. If you compare that to credit ratings, which have like 95% plus correlations, you could see how subjective this is. And it has a lot to do with what data they decide to measure, right? It has a lot to do with how they weight the data. It also has a lot to do on the timeliness of data collection, right? If your rating is updated for carbon emissions at a certain time of year for some companies and not for others, that's going to, and a different ratings provider is gathering data on a different schedule, updating their ratings at a different schedule. The gathering frequency and the times of the gathering can have a huge effect on ratings. So that's unfortunately the state of things. Have been getting a little better, but still a long way to go if you're using the ratings to make decisions.
let me just maybe add something to that. There was a study published in June by some academics at Harvard, MIT. And one of the things they looked at was the average pairwise correlation of the company scores. So this is a very kind of well-vetted piece of work, and the average correlation was actually 0.29. So it's actually pretty bad among the top vendors. And a way to think about the contrast with credit ratings are pretty consistent across suppliers. And it's an easier problem because all you have to do is measure the probability there's an event. But it's difficult to talk about the ESG event, right? So how do you think about, why it how do you get the score right? So the answer to that is just a lot of data and the timeliness, the kind of things that Ben's been talking about. So the correlations among single vendors is very small, and it continues to be pretty problematic.
All right, so appreciate sharing the slide there. So this slide is essentially this is from a study done by actually a large ESG investor who subscribes to data from over 22 different ESG data providers, right? And the purpose of that study, and they had many different slides in that study, but the slides really were discussing what the quality of ESG data and comparing different vendors to each other. For example, 83% of the time, the vendors disagreed on how many women were on the board, right? So the disagreement between vendors is not only isolated to ratings. Here, what you'll find is what we find is the cause of a lot of the disagreement between vendors, and that has to do, frankly, with the timeliness and the accuracy of their data collection. This slide shows the ESG, three largest ESG vendors. I can't name names, and their data across MSCI ACWI as of September 2022. And if you look at the carbon emissions data, a large portion of it was time decayed because 2021 data was available, right? And unfortunately, data being the lifeblood of everything you do when you make strategic decisions or investment decisions, or whether you're reporting on the regulatory relief on your portfolios, for example, or your investment products, if you have data that's time decayed, data that's inaccurate, you're not really doing what you're saying you're doing, right? And you're making decisions on incorrect data, which can lead to spurious outcomes, right? And unfortunately, the data in the industry is highly inaccurate, highly time decayed, and it needs to have a refresh. It needs almost to have a reboot, so investors and corporates can make better decisions. So this is a great example of how data can lead to how do I say it? It's better to say how canned data can lead to an incomplete view of a company. So for this, what you're seeing here is our snippets from some of Starbucks ESG reporting on how they're trying to lower their use of water, right? The water intensity of their business, right? And we're not trying to pick up on Starbucks here. This is actually quite commonplace, right? But on the left, you'll see that Starbucks talking about how they want to significantly reduce their water usage, and replenish water, recycle water, repurpose water, right? And across all of their operations, right? But then in another report, buried in a footnote 100 pages later, I think it may be the same report actually, they mentioned that they don't consider the use of water in their stores as part of their operations, normal operations, core operations. And so, but that's a huge component of Starbucks' water footprint, right? And water use. And so those two statements don't really mesh. But imagine if you are manually gathering this data and you're an analyst at one of the large shops and you're trying to put a rating on Starbucks on a KPI having to do with their use of water, or if you're trying to gather a data point on their progress towards lowering their water, and you didn't see that footnote. And even if you did see the footnote, how do you mesh these two very disparate and somewhat can be viewed contradictory statements within their disclosures? And that becomes a very huge problem when you're an analyst who is trying to figure this out for Starbucks here or in any ESG issue that you're researching. And increasingly, investors, corporate consultants are turning to are realizing the data from the major vendors is not the solution. They're actually starting to look into the documents themselves to catch these types of contradictions. So next, and you're seeing these contradictions really rearing their ugly heads in the market, and investment shops are getting fines, right? They're putting out products, right, into the market that they claim are ESG. And to be blunt, I'm not saying that they weren't trying to be ESG or didn't have good intentions in what they were doing. But you see here that Goldman Sachs got a fine for one of their products. DWS recently got a fine. I think it's a 25 million. Or excuse me here, I think it's 24 million. Anyway, either way, it's 25 million. It's a large fine because they're actually not investing in according to the ESG principles that they are advertising in their prospectus. And a part of it is a data problem, right? They're having trouble to follow their own methodologies, right? Or they're not updating their decisions in their portfolio enough because of the fact that they don't have the data to update at the frequency they're promising. They're going to be rebalancing the portfolio or eliminating companies from their portfolio. So this is really having real world consequences, and it's a big part of it. Yes, there is greenwashing, but a big part of it is a data problem, and that data makes it really, the state of the data makes it really hard for investors to avoid accusations of greenwashing, right? Because they don't necessarily have the data or the transparency in the data to back up the good intentions of the products they're putting out in the market.
Great observations, Ben. We have in this idea of do we trust and how confident are we? We have a poll. So if our EDM webinar audience can get on their keyboard, this too, I believe, is a single choice. How confident are you that your investments and portfolios are aligned with the ESG goals they claim to accomplish? Again, it's single choice. This is a confidence meter from not confident at all the way up to highly confident. Again, this is anonymous. Just give it your take from where you are and your engagement around ESG related activities. Give it a moment longer. You can see the numbers tallying up here. Okay, I think we can present the results to everyone. And here's Ben, we've come in at 63% somewhat confident.
Mm-hmm.
So 22%, which is the second highest voted amount, not at all confident, 15% moderately confident, and no one picked highly confident. So this curve sort of betrays a lack of confidence. Is this a surprise?
Yeah, it actually is not a surprise, and I think I'm not sure, again, 100% sure the audience, but I'm not sure how many portfolio managers are on this call, or people actually making decisions around the money and how to allocate it in a portfolio. But I think a lot of times we get on ourselves onto calls with ESG experts, like people who've worked with the data for many, many, many years. And then we actually find out, and when we peel back the layers of the onion, that they didn't actually realize how time decayed the data they had was, how inaccurate it was, or if it was how much modeling was involved, right? And so oftentimes we've seen over the years a higher level of confidence, but over time we've seen that when we start talking to people, that confidence has started to degrade, and when they actually see what's really going on. So it's I'm not saying that they shouldn't have reason to have some level of confidence. There can be some really, really great ESG experts on this call who are really digging in to the actual sustainability reports and reports and actually grabbing the data themselves. So those groups in the industry that have started to do that are actually the ones that are starting to have high confidence, but they've been forced to do it. And now they're investing the time and energy to do it well. And then they do have reason to be confident, but they're still going to have to deal with the issue of, okay, how do you know what the corporates are reporting is accurate, right? And so there's still a little bit of, you still have to worry about greenwashing somewhat in that scenario. And I shouldn't say a cottage industry at this point, a huge industry at this point of working with corporates to get assurances on their data, to improve their reporting, to make sure it's more accurate.
So Joseph, you see the results, 63%. If this is a 1 to 4 scale and 4 is maximum confidence and 1 is lowest confidence, the vast majority of people have voted in 2 or number 1, which is very low in the confidence factor. Is that awareness a surprise or a market that's beginning to realize there's some real serious data challenges?
It's not a surprise. In fact, I think this is one of the core issues for investors. And I addressed this a couple of slides out. You'll see some work we've done on this topic. I think this is really a core issue because as an investor in a portfolio, what do you own as an ESG product? And by the way, how do you compare investments? So that's really, really important. And we'll talk about that in a couple of slides. I think this is really a core issue. So I'm not surprised, and I think it's a problem that needs to be addressed.
Good. I guess, Ben, back to you to help educate our audience on what are some of the underlying issues.
Yeah, so I think I've probably gone into this ad nauseum at this point about the inaccuracy of ESG data, the lack of updates. Usually the update frequency for the average ESG vendor is 21 to 30 months. So it's not annually like the data is being gathered. And just the sheer amount of modeling that's involved and lack of transparency. Where's this data coming from? There's a lot of pitfalls here, but instead of really doubling down those pitfalls, what I'd rather do is to talk about why, right? The reason why is, again, go back to those unstructured documents we were discussing, right? The typical ESG data vendor or ESG analyst who's trying to get data are getting it from these unstructured documents, and they're doing it for the most part with highly manual process. They have a document on one screen and they're scrolling through it or control Fing through it. They have a spreadsheet open on another screen and they're grabbing the data from the document, entering the spreadsheet. And it takes lots of time. It's very frustrating. It's prone to human error, and it's very expensive. And so that's what leads to a lot of the problems in the data. It's too prohibitively expensive to do this frequently, to gather it frequently. And just the very process is very prone to error, and you need a lot of people, and those resources don't scale very well, right? And that's a problem. And then a further problem is that the data sets that are on the market don't really cover all the needs that the investors have. They have bespoke needs for data that's not provided. They have their own different way of looking at things. So, for example, your interpretation of board independence may be different from your data vendor's interpretation of board independence. So, like you said earlier in the call, Mike, that once you get the data, there's a whole bunch of work that analysts at whether you're a corporate consultant or you're an expert ESG investor or head of sustainability data at an asset manager. There's so much work you have to do once you get the data to verify the data, interpret the data, and put it into a usable format. In fact, that actually leads to data fatigue. And a lot of 99% of the collected data that is provided is not used by the corporates that are licensing them.
Wow.
It's absolutely insane. Going back to that preparation to actually be used, 2/3 of the average ESG analyst time is spent actually going into documents to verify data, to interpret the data, even though they've gotten data licenses, right? So it's a really big issue, and it's all caused by these manual processes, these unstructured documents. But the good news is there's technology coming out, and there's hope for better ways to do things, and there are better ways to do things in the market. So
I like the phrase, Ben, data fatigue.
Yeah.
Which is, I spend so much time working on data that I have no energy left to really do any value-added reasoning or strategic analysis. It's a big issue, but I think hopefully there's some solutioning here. I think that's about what you're going to cover at this point.
Yeah. Let's go to the next slide. So we all have heard the buzzwords of AI, right? Artificial intelligence. Now, to be very, very clear, AI is not like a panacea to all problems. You don't bring AI into things and automatically all your problems go away. But AI can be an amazing tool to deal with these issues that we've talked about, to deal with how do you collect data from unstructured documents? How do you get the benefits of scale, that multiplier effect on your work, right? And then, like you said, Mike, you're getting this data fatigue. You're spending so much time dealing with the data and herding the data and getting it into the pen per se and getting it where you need to use it, right? Well, then there's the next part is, well, now that you use it, how do you apply it? Even then, that's not easy. There's a lot of work that goes into, now that I have the data, how do I apply it? The great thing about AI is that you can actually now get to the point where with the right partners and the right technologies, that you can actually use AI to extract data from unstructured documents much more accurately than humans can do it, and much more frequently and speedily, right? You could also, using that same AI, you could do it at scale. You could get, where one human analyst could probably go through, and work and, do their work on a company, depending on how deep they do it. They do their ESG research from a few hours to a week, depending how deep you do it. Now that same analyst may be able to do 10 times their output, right, of research, because they have an AI tool that allows them to do it at scale, right? Do it faster, more cheaply, more effectively. And then once you've got the data, however you got the data, whether you were using traditional manual methods to get the data and get it where you want to be, or you used AI to help you do it much more quickly and effectively. Now that you have it, what do you do with it? And there's a lot of things that people in the market use AI data for, insights into alpha or risk mitigation opportunities in their portfolio, which we're going to talk about a little later in this webinar, but also maybe writing sustainability reports or peer analytics. And sometimes AI can do these things on the fly, and can give you those insights, or get you like 80% to where you need to go on what you're doing, and save you a lot of the work and give you a massive head start. So there are solutions to make your lives easier.
By the way, Ben and Joseph, we are starting to get questions coming in, which is great. I think we're going to proceed through a couple more slides and then start diving in. So please keep typing your questions in. We are going to plan to answer as many on this live EDM webinar. So back to you, Ben.
Yeah, I have there's about 4 more slides left in the core part of the webinar. A couple of them are ours, but I really want to get to Joe's. So I'll kind of quickly go through this one. There's a lot of great technologies out there, like, for carbon accounting, carbon offsetting, right? And you can, for example, build investment products where you use carbon offsets that are tracked on the blockchain, and integrate that into your investing, so that you can still get, for example, in this case, you can get a carbon offset adjusted or carbon risk adjusted yield on a dividend strategy, for example, right? So you can accomplish your investment goals, and at the same time invest in companies like they're traditionally carbon intensive, and still include them in your portfolio. But that all starts with good data. If you don't have accurate emissions data, how do you know what you're offsetting, right? And how do you track it on the blockchain accurately? You can't, despite the technology. So there's a lot of things that AI and accurate data can do to make your investment better. Let's go to the next slide, where Joe can dive into some of his research.
Thanks, Ben. So I'm going to address 2 topics here. First, the performance issue for investment, and then the second slide will be about this whole confidence topic. So let me talk about performance first. So quality investing has become very, very important. Obviously, it's become particularly important or popular lately with Ukraine and what's going on in the world. And when people in equities do quality investing, they typically look at profitability of the company as a key metric, or return on equity, ROE, as we have here. So what we're looking at here is the following question: can ESG benefit a quality investor in stocks? Okay. And we're looking at ROE. We take the top 1,000 market cap stocks, basically the Russell 1000 universe. And in the red line, what we're looking at is the return since 2016 of holding a long short portfolio, buying the best profitability companies, shorting the worst profitability companies in the Russell 1000 over this 8-year period. And what we've done importantly is strip out industry effects, sector effects, size, all these things that could affect your performance. Strictly focused on ROE. How we do that, we can get into. So that's the red line. So can ESG help, and why should it help? And the reason it should help is that in ESG, you're capturing some non-financial metric features of companies that are not really well captured by the classical data metrics. And I say also importantly, what I'm doing here is using the OWL data, because as we mentioned earlier, each vendor has this story and they're all uncorrelated. So the way out of that problem is statistically to take a consensus approach. So we can get into it later, but we're using the OWL data, and in these charts, what we're doing is in the green line, I'm asking the question, what if you take this return on equity profitability metric to own stocks, but don't buy the profitable companies unless they're also in the top half in terms of ESG for that universe, and don't short stocks unless they're in the worst half. And that's the green line. And the black line was saying, let's focus a little bit more on profitability. And maybe governance is really the key issue. And in the governance data, you have things like about the board and things like that really aren't well captured by the classical financial metrics. So in the black line, what we're doing is buying the most profitable companies and only owning them if they are in the top half of the governance metrics, and shorting only if they're in the bottom half. And that, if you compare the black to the red, you get 3% a year excess return over the quality investor class of metrics by being an ESG investor. So the point being made here is that ESG can, it doesn't have to, and it depends on what the data used, depending on the metric. But here's an example of where ESG clearly is a benefit to outperforming your investment in a sort of another way of getting at that topic. Let me turn now to the next slide, which gets back to the polling point, a little bit complicated. Let me explain the issue here. So the confidence in ESG for investment portfolios, what do you own? I mean, you buy a stock, but you own a portfolio. So what are you owning in terms of ESG? So look at the little chart on the right and the red line on the bottom. So what I'm plotting there is the ESG score for the S&P 500. This line goes up over time. So what we're doing is taking each company in the S&P 500. It has an ESG score according to OWL. It has a weight according to just the way it's done in the portfolio. And it sort of evolves over time. The reason it goes up is because the market cap in the S&P tends to be more heavily towards the large cap companies. Large cap companies tend to have better ESG metrics, so it kind of evolves over time. And it's in a passive investment, which people want to do. So let's say we want to actually create a passive investment that's a better ESG animal, if you will. So what we did with the green line is let's take the companies in the S&P 500 and we do an optimization. So we want to pump up the ESG score of the portfolio while tracking the S&P. So you can do that trick. In other words, we want to create a passive investment vehicle that has actually better ESG qualities than the S&P 500. And we did that. We can get into details. And that's the green line. So what's important in this chart is that what I've shown you here is an ESG measure for a portfolio. That's the S&P 500 at the bottom. We've shown an ESG measure for a way of improving that portfolio. That's the top green line. And by the way, for performance, look at the left chart. The chart on the left is showing the cumulative return. The red line is the S&P 500 over time. The green line is this version of the S&P 500 where we rate the companies to give an improved ESG score. That's the green line on the right, while trying to keep close to the S&P 500. But by the way, you outperform. You outperform 85 basis points a year, almost 1% a year outperform. But that's not the main point here. The main point here is that when you own a portfolio and you think you're doing the right ESG thing, how do you know what you're doing? And when you compare that to another portfolio, how do you know what you're doing? So the idea here is you can measure that, and you have to measure that in a consistent way. And this is an example of how to do that. And you can compare strategies. So as an investor using ESG, do you want to create alpha? Yeah, maybe you do. But I think most people who are doing ESG portfolios really want to satisfy the regulators, their constituents, their own sense of what's right in the world. Alpha is interesting, but the real issue is how to create an ESG beneficial portfolio without screwing up your equity strategy, right? And that's what we're showing here. And the only way you can do that, and only how you have confidence in what you're doing, is if you have a way of measuring it. And this is an example of how to do that. So I hope this wasn't obscene made, is that you have to be able to measure the ESG quality of your investment portfolio, which you can do, and then you can begin to compare portfolios. And so the way to get confidence is to measure. And this is what we're trying to illustrate in this example.
Joseph, these are big takeaways, right? Is your main point is that if you do this right, you're going to outperform traditional indices, and number two, you're going to have comparability.
Right.
And that's vital. Otherwise, you're comparing apples to bananas, and you're exposed if you do that. So there's a whole bunch of benefits of getting the data straight and then building your strategies off of consistent, reliable data. I mean, it's clear anyone here listening that's involved in the investing world, either as a consumer or creator, that's a huge plus.
Yeah, yeah. You have to be able to measure and compare, and this is what you have to be able to do.
Yeah. Ben, back to you.
So thank you. Agreed. Everything that ties that together, though, is having quality data and ensuring that you apply it rigorously and you apply it in a comparative way, right? And I wholeheartedly agree with Joe. I mean, Joe comes from, he's built strategies, a huge investment strategy, a huge portion of his career. I've spent a good amount of my time as part of Al working with quantitative investors and fundamental investors. And we know how hard it is to actually manage money, make those decisions, and outperform the market. And there's a lot of things that go into that, but there's consistently been shown that you can, like Joe said, employ ESG to invest and not necessarily reduce your risk-adjusted returns while at the same time achieving your ESG goals, right? That said, there are white paper after white paper which demonstrates that there are select opportunities to actually generate alpha or to for example, mitigate against risk or drawdown and things like that. Here's just one quick example of a partner of Al that used a social signal and an emission signal from our data to actually build a shorting strategy where they, over the first half of 2023 in their model portfolios, they were able to have 15% alpha compared to the market. And so compared to what the benchmark that they were comparing against. So again, there's a lot of examples of this, and the ability for any individual investor to employ it well or not, it is going to vary from investor to investor. But the key thing to note is if you go into it with data that's not updated frequently, data that's time decay, data that you're not sure is accurate or even potentially even modeled, right? You're already starting behind the 8 ball, to use a billiards expression. And so no matter what you do, having accurate data and quality data is going to be important to make sure that your research and your results are actually based on a quality foundation.
Wonderful. Thank you, Ben, and also Joseph, for your insights. We're going to now open it up to questions, and we have a really good fundamental question that came into the Q&A box. It's from Jerome. And Ben and Joseph, I'll put this as a jump ball. You can pick who grabs it first and wants to run with it. But here's the question from Jerome. It's a great basic core question. Are there any regulator or regulatory initiatives to implement a regulatory framework to have a common definition of ESG data to be reported? So that to me is driving around. What are the standards that regulators are trying to bring into the market? Is that the issue, or is that the opportunity?
There's a lot of it. So you already have the SFDR regulation in the EU for fund managers who want to claim that they're sustainable funds. They have to report uniformly on certain ESG metrics. And then you have the kind of what I call the sister regulation, CRCD. Excuse me, I may forget the acronym more. Corporates actually have to report on pretty much the same metrics that the SFDR is requiring them to report on, right? Requiring fund managers to report on. You have the TCFD, which is a regulation that I think pensions have to report on in the UK. But in turn, a lot of the industry is looking at it, because the way the TCFD looks at it, and I think it's smartly so, is you have certain environmental, and they also have just recently released their social issues. You have certain environmental issues that may be material to your business, right? And you in your reporting have to discuss how you're mitigating against those risks, right? So it's not necessarily in this case a data requirement, which I think is somewhat smart to not necessarily have it a data requirement. The data the data you need to report on would be data that is directly related to the risk mitigation discussion. And I think that's better because it forces the pensions in this case, but also you have upcoming regulations in Europe which are going to force corporates to discuss how they're mitigating risk or adapting against risk, right? And you actually have to have a cogent, cohesive narrative of what you're actually doing to prevent those risks or mitigate those risks, and you're opening yourselves up to people evaluating it and calling spades on it, or calling it, hey, this is brainwashing, right?
Right. Great points, Ben. Joseph, anything you'd like to add on that particular question of regulatory initiatives or regulatory frameworks for common definitions to ESG data?
Not much to add to Ben, other than I say that the need is to have comparability across companies. So how do you get something that you can compare companies to each other? That's really key. But I'll defer to Ben's answer.
I would also add that the SEC has put out carbon emission is regulating carbon emissions disclosures. California has now just done that as well, the first state to do it. So I mentioned earlier, the genie is out of the bottle. It's really out of the bottle on the regulatory front, and it's
more
it's
to
only
come.
going to get, yeah, it's more to come. Yep.
Right. So here's a great question. It came in from Lalitha, which is, and it gets back to what can we do about this? And it's about ESG policy. So where do we get ESG policies and procedures for financial firms? And also, are there assessments to check if the policies are being enforced and implemented?
So you can look at it from two perspectives. For financial firms, from their corporate perspective, right? A lot of them may be listed companies, and we'll have to put out 10Ks, 10Qs. They'll be putting out annual reports. There's a lot of corporates do a lot of ESG disclosures, but a big portion of those disclosures come in unregulated disclosures like sustainability reports and annual reports, right? That are unstructured and not, how do I say it? Have common frameworks, for example. Now, but if you're talking about from the perspective of a fund, you're going to look at their prospectus. At their prospectus, they'll be telling you if they are using ESG as a consideration for their investments, and the rules and the kind of criteria by which they're making investment decisions for around ESG. And that's where you saw earlier on where there was a lot of regulatory fines, because in those prospectuses, those fund managers were saying they were going to do this, but according to the regulators, they're doing this, right? And that's where the fines came from.
Joseph, anything to add on that topic?
It occurs to me when you mentioned it, occurs to me there's an interesting potential opportunity here for AI, in the sense that if you take sustainability reports, so if you look at the cross sustainability reports, they're all kind of different, but maybe they're not different if you really get at the semantics of the report. So there may be an interesting, I don't know if regulators look at this, but maybe an interesting way to sort of speed up some of the issues of auditing companies by asking the question whether there's some equivalence in terms of what's being communicated. Just because it's going to take a while to get this right, isn't it?
Yeah. A great additional question came in just as an observation by listening to Ben, what you were covering, and Joseph. Question is as follows: as ESG data usage proliferates, what are your views on how much data quality assurance can be effectively done given all the points you've cited? Voluntary data, manual collection, methodology differences, even regulatory differences. I'll add that one in as well. And as data is utilized for regulatory reporting and risk management, there's also an expectation that the quality of the reporting and its underlying data will be akin to other types of financial data. So there's a dual issue here. Data is proliferating. There are challenges on how it's being collected. And at the same time, regulation is saying you could be subject to fines and penalties. So where's this all heading?
So in, I believe it was 2021, our company embarked, it was 2020, our company embarked on building AI to collect data from sustainability reports.
Cool.
But what I did every night was stay up myself, and I went through every Russell 2000 company at the time over the course of a year. I spent 10, 15 minutes on their documents going through what was said there. Now, here's I'm relating it to in those documents and what was reported, what wasn't reported, and all that stuff. Of those 2,000 companies, I would say about 7 or 8 had reports from third-party assurance firms who went and did an audit of some kind. So akin to what a E&Y or a Price Waterhouse or a Deloitte would do for financial statements. You have firms that are popping up that are doing assurance to verify the accuracy and quality of these disclosures, right? And so it's evolving. I've recently been revisiting my nightly project and seeing what the state is. And it's still few and far between, but I have I've seen a noticeable increase in the volume of assurance of reports that are there. Is it perfect? No. I'll just really quickly, one problem. One of the scope 3 carbon emissions data points is commuter travel, like to and from work. Well, how do you truly accurately measure the emissions of your employees going to and from work? They all have different types of cars. They all have different driving patterns. They drive fast or slow, which can cause them to change the amount of emissions you have. So it is a very difficult problem to solve. And I personally think we're decades away from getting it to the point where it's as similar to financial data. But we're taking, what we call baby steps. It's getting better. And there's billions being spent by each of the large audit and advisory firms to help solve these problems and to help corporates measure their data. And they're spent. And if you want to say one thing, the corporates are spending money on this. They are spending real dollars with the Ernst & Youngs and the big audit firms of the world to actually help them do a better job at measuring these things. And I think you got to give to all the corporates on here, you got to give credit where credit's due to them. It's a difficult problem, and they're kind of in a no-win situation because everyone expects perfection from them and are going to immediately think greenwashing. It's not easy for them. And I'll just say that.
So Ben, the time always goes quickly. It would be great if you didn't mind sharing, and we'll turn back on the slides, a little more about OWL ESG. And then, specifically for our audience, really good for them to hear how leveraging AI is a way to really help tackle the problems that you and Joseph have been outlining. So over to you, just for the team on the call, to learn a little more about what you all do.
Yeah, I appreciate it. So, our mission is to help investors, corporate and consultants really get the economies of scale of using AI for a primary ESG research, as well as for content generation and insight, right? As we mentioned earlier in the call, the industry is plagued by inaccurate, stale, modeled, not transparent data. Where does this come from, right? And this has caused ESG analysts, whether you're at an institutional investment firm or you are at a corporate consultant, who is helping boards doing peer benchmarking or other types of strategic ESG initiatives at the firm, it has caused those ESG analysts to actually spend an inordinate amount of their time doing primary ESG research and going into sustainability reports, annual reports. Or if you're at a corporate, let's go into the different documentation that's produced across our firm where ESG data may be embedded, right? And they're diving into those documents to collect ESG data. And it is I shouldn't say insurmountable, but close to insurmountable problem, requiring a huge portion of these ESG analysts any given day, week, or month, or year is spent on these manual tasks to get the data. So AI can give you those huge economies of scale to gather effectively, accurately, and get you take that huge portion of your day, right? And shave off 80% of that, headache-inducing labor, and get you ready to just dive into actually acting on the insight and intelligence you gained, and to actually doing the high-value work that you were gathering the data for in the first place.
Awesome.
And then next slide. So yeah, so what you mentioned earlier in my bio, we're actually launching the first AI powered AI powered ESG research platform that will allow users to actually conduct that primary research, go into documentation, extract data en masse and at scale to find information that is hidden deeply in those documents. And instead of having to read through those documents or control Fing those documents, finding those documents online, right? Those documents are available at your fingertips, a simple search away, and you can find what you're looking for. Really, our goal is to give anyone here who's an ESG analyst who spends their time in that research or needs accurate data and has to corral all that data to make it workable. Our main goal is to give them the gift of time, hours and days and hopefully even months of their lives back, because we're giving them the power of AI in their hands, whether it's on their pad or on their computer, to increase their productivity and their work output tenfold and in a small amount of time.
Ben, we're almost at the top of the hour. I don't know if there's a final slide on how people can get in touch with you.
Yeah, let's move to the last slide.
One more slide ahead. There we go.
Yep.
You want to just give a quick synopsis? I see Rob Yates and Mark, and we're going to publish these slides, by the way, and all the questions will get formal answers. So Benjamin and Joseph, thank you for your time. This is brilliant. I almost look at the work you're on as the cure for data fatigue. So,
we really appreciate
certainly
it.
help in a big way. Thank you for attending, everyone. Benjamin, Joseph, thank you for participating today. There's also reports available from the EDM Council looking at that data supply chain. And Benjamin, as you mentioned, so many companies are investing this time and effort. We've helped to compile recommendations on how to help companies through that entire supply chain of data management. And your platform is right at the heart of being a great aid. So thank you, everyone. Have a wonderful day, and we'll be in touch.
Thank you.
Thanks, everybody. Appreciate it.